Ever wonder why the rich seem to win big in crypto while everyone else gets burned? It's not just luck, it's strategy. While most people panic during crashes and chase trends, wealthy investors move differently. What if you could follow the same game plan they use to grow wealth in any market? In this video, we'll explore how the rich think, invest, and win in the world of crypto, and why retail investors everywhere are adopting the same strategies. Rich crypto investors think very differently from most everyday traders. While many regular people rush to buy coins when prices are high and exciting, the wealthy often do the opposite. They quietly buy more when the market is down and people are scared. At Token 2049 in Dubai, Cointelegraph's Bradley Peak spoke with some of the most influential figures in crypto, and one insight stood out. The wealthiest among them all shared a common mindset. They were diamond hands, investors who held firm through volatility. That conviction paid off, with many of them amassing millions by staying the course when others panicked.
What made you so rich?
What made me so rich? By buying Bitcoin in 2014.
Yeah?
Yeah.
You still got it?
Yeah.
Still got it. Still got it.
Diamond hands.
Every day, traders want fast money and chase trends, which often leads to losses. But wealthy investors play the long game. They see market ups and downs as chances to grow their wealth, not something to fear. The question is, how do they do it? Well, it comes down to the three pillars of the crypto wealth formula. The first pillar is wealth accumulation, aka buying crypto in bear markets. Rich investors see market crashes very differently from regular people. When prices drop and everyone panics, the wealthy see a golden chance to buy more. In crypto, crashes can be big. Coins like Bitcoin have dropped over 80% in the past. But instead of being scared, wealthy investors get ready. They save up during the good times so they have money to invest when prices fall. While most people sell out of fear, the rich slowly buy trusted coins like Bitcoin and Ethereum during these downturns. They know that after every crash, there's usually a strong comeback. This buy when others are scared mindset helps them grow their wealth and get ahead when the market bounces back again. In fact, one of Warren Buffett's most famous quotes is, "Be fearful when others are greedy, and be greedy only when others are fearful." And now you know why the rich cling to this one. That brings us to our second pillar, passive income. See, the rich don't just buy crypto and forget about it. They focus on making passive income from crypto, and that includes exploring opportunities like staking and DeFi lending. In fact, people are finding out about these avenues every day and regretting their decision not to take action sooner.
One thing that I love about Coinbase and something I wish I started much earlier was just the fact that you can earn additional interest just off your investment. As an example, I went ahead and staked my Cosmos Atom, and staking is pretty much just allowing your crypto to sit on their exchange where you can earn interest and you can unstake it at any time.
And so these strategies help enhance the total returns beyond mere price appreciation. For example, if you end up generating a consistent 5-10% annual yield on holdings, you'll see substantial compound growth over multi-year periods while also saving you the trouble of having to sell assets during unfavorable market conditions. It definitely beats letting crypto sit in your wallet simply for price appreciation. That brings us to our third pillar, separating wealthy crypto investors from retail traders, risk management. Retail investors often either overexpose themselves to a few high-risk assets or avoid risk altogether, lacking a balanced strategy. In contrast, wealthy individuals rely on sophisticated risk mitigation techniques. They're not afraid to make tough calls. So what gives them that level of confidence? Well, these wealthy investors take advantage of portfolio diversification. Instead of just sticking to blue chip coins, investors seek out new coins after considerable research, of course. More importantly, The rich don't just invest and sit back. They constantly reassess their portfolios using strategies like hedging with futures or options and adjusting position sizes to protect capital during major market corrections.
So these aren't like one-off events that this occurs. So, sizing and weighting within your portfolio as well. How big of a position is it? If that position declines 50% and it cuts its dividend, what does it do to my overall portfolio? And if you're taking sizable impact, and that's just a good math exercise to run in your portfolio on a regular basis, right? So just, build a spreadsheet, put all your positions in there, weight them based on their price, and then put a drawdown scenario and then see what the impact is to your overall portfolio. Go, can I live with that? And if you can't live with that or don't want to live with that, that's a good opportunity to rebalance that risk.
On top of that, wealthy investors prioritize regulatory compliance, working with specialists to ensure their crypto activities align with evolving regulatory frameworks. But the single most important factor that sets wealthy investors apart from retail investors is understanding market volatility and coming out the other side. Market volatility often triggers emotional responses in retail investors, forcing them to make poor-timed exits during downturns. But wealthy investors have a whole different story. They don't fear market crashes. Instead, they view them as an inevitable part of market evolution.
It is the world's greatest free market. Maybe the greatest free market of anything. I wonder, is there any product in the world that is traded globally 24/7, 365 in multi-billion-dollar components?
And this insight comes from analyzing the market for years. Bitcoin has always been unpredictable with historic drawdowns over the years. However, wealthy investors have internalized these cycles, understanding that bear markets create the foundation for future growth through various avenues, like the elimination of weaker projects, the development of strong fundamental infrastructure, and the reduction of excessive leverage. The result? They're able to accumulate quality assets at discount prices, deploy capital into promising projects, and position themselves for the eventual recovery when the market eventually bounces back. And they're able to do this all because wealthy investors exclusively study market patterns over the years, allowing them to make informed decisions.
Number one, the halving event written into the Bitcoin code occurs and Bitcoin enters a parabolic uptrend for about 1.5 years. Number two, the market tops and 1 year intense bear market begins. Number three, the market finds a bottom, which is followed up by 1.5 years of slow movement back up until the next halving event.
And so the question is, how do you think like a long-term investor in crypto and not a rookie? Well, you can start by following the 3-pillar approach: accumulating crypto investments, leaning towards long-term holds, and exploring passive income streams. Your focus should be on multi-year horizons, not daily price movements. The best approach is to set clear holding timeframes for yourself, make investments, and stick to them despite how the market moves. And if you do find yourself in a bear market, you should focus on purchasing quality assets at regular intervals and ignore the short-term price fluctuations. On top of that, develop a portfolio allocation model that balances risk and opportunity across different cryptocurrencies instead of concentrating on high-risk bets. It's the same disciplined approach the wealthy use to preserve and grow their capital. As for controlling your emotions during a bear market, the best strategy is to create predetermined action plans. You should also look into studying the market trends so you can make informed evaluations. Every day, more and more individuals are leaning towards these strategies. And it's not just individual investors. We're seeing a shift in sovereign wealth funds as well. FYI, a sovereign wealth fund is a state-owned investment fund. According to the International Forum of Sovereign Wealth Funds, there are nearly 100 sovereign wealth funds globally, collectively managing over $9 trillion in assets. About 45% of these funds are financed by revenues from natural resources, while the majority come from commercial surpluses. However, more sovereign funds are stepping into crypto using these strategies every day. the sovereign fund of the U.S. state of Wisconsin, was the first to invest in spot ETFs through the iShares Bitcoin Trust ETF. By mid-February 2025, Abu Dhabi's sovereign wealth fund, Mubadala Investment Co., had followed suit by acquiring 8.2 million shares in the iShares Bitcoin Trust ETF. It's expected that in the face of rising geopolitical and economic uncertainties, retail investors will shift towards long-term accumulation strategies. BlackRock Chief Executive Larry Fink recently also commented on the situation, saying, "If you're frightened of the debasement of your currency, you can have an internationally based instrument called Bitcoin that will overcome those local fears." On top of that, experts believe that BlackRock's launch of its European Bitcoin exchange traded product could drive institutional adoption in Europe. At the end of the day, Fink's comments and the success of wealthy investors are proof of the inclination towards these strategic crypto approaches that were previously limited to pioneering wealthy investors. Are you investing like the rich or like a retail trader? Drop your thoughts in the comments below. And if you're serious about stacking your future with smart crypto strategies, don't forget to like, subscribe, and hit the bell so you never miss a video.